Good evening, students. Today we are going to start with income from other sources, and I'm going to cover first the remaining part of capital gain, the exemption series. But before we start with today's class, do you have any doubts with respect to the previous class? So in the last class, we had covered reorganization of business, wherein we had dealt with amalgamation, demerger, transfer of capital asset by the holding company to the subsidiary company. And we had also covered about slum sale, conversion of company to LLP or partnership firm to company. So do you have any doubt with respect to this before we start off with the class? Good evening, Anjali. Any doubts with respect to the last class? Okay, so if there are no doubts, let's start with today's class. So today, I'll be covering, first of all, exemptions. From Section 54 series. Now, what are these exemptions? Let's look to it. Section 54, first of all, it provides for exemption on transfer of a residential house property being land or building. Right? Section 54 talks about a residential house property being land or building, which is acquired for the residential purpose, right? The income of which is chargeable under the head income from house property. And what you need to acquire to get the exemption? So you need to acquire residential house property. So house in exchange for a house. That so what is eligible asset? Residential house property. Now, how many residential house property? So it says 2 residential house property can be acquired. 2 residential house property can be acquired, subject to the condition that, what is the condition? Amount of long capital gain does not exceed rupees 2 crore. Amount of long-term capital gain does not exceed 2 crore. And this option can be exercised only once in the lifetime of taxpayer. What does this mean? So if you have a house property which you are selling and the capital gain is long-term capital gain, then in that case, what do you need to do? You need to purchase against that another house property. And if you purchase another house property, then you will get the exemption, right? You will get the exemption for that. Now, Section 54 was recently amended. What does it say is that you can purchase two house property. You can purchase two house property, but the capital gain amount should not exceed rupees 2 crore. It is optional it is at the option of the assessee that if the capital gain amount is less than rupees 2 crore, he can purchase two residential houses in India. But this is one-time option during the lifetime of the assessee. Right? So where you any assessment year, the assessee exercises this option to purchase or construct the two residential houses in India, he shall not be subsequently entitled to exercise the option for the same or any other assessment year. Clear? So what does it imply? That say, for example, if an assessee has availed the option of claiming this benefit under section 54 and he purchases two residential houses, say one in Jaipur and one in Mumbai, and he has a long-term capital gain of rupees 1.50 crore from transfer of residential house, say in Pune, then he will not be entitled to avail the same benefit in respect of any other house purchase, any two house purchase, say in the next particular year, say in Varanasi and Kerala. So he can avail this offer only once in the lifetime. He cannot avail this offer again and again. Clear? So this is the once in a lifetime opportunity given to the taxpayer. Otherwise, you can purchase only one residential house property in India. The capital gain should be long. Clear? By when the house is to be purchased or constructed, so time limit is purchase 1 year prior or 2 years from the date of transfer. 1 year prior or from the date of transfer. And construction within 3 years from date of transfer. So 1 year prior or 2 years from the date of transfer and within 3 years from the date of transfer. Is it clear? Then what is the amount of exemption? Amount exempted is lower of long-term capital gain or amount invested. Clear? The lock-in period for this is lock-in period for newly acquired asset is 3 years from date of acquisition or construction. So you cannot say newly in a period of 3 years from the date of acquisition or construction. And in case you violate or break the lock-in period, say before 3 years from the date of acquisition or construction, then the exemption claimed earlier will be revoked. Exemption claimed earlier will be revoked. Clear? So the arising from the transfer of such asset shall be computed by reducing the capital gain exempted earlier cost of acquisition. So how will you do that? The capital gain exempted earlier, you would reduce it from the cost of acquisition while you will compute the gain of that newly bought asset. So you will reduce the cost of asset itself. Did you get this? So if you transfer the asset within a period of 3 years, then in that case, you will not get the exemption which you have got earlier, and you will have to pay the capital gain tax by reducing the cost of acquisition which you have purchased earlier. Clear? Is it clear? So let's solve a sum on this. Let's solve a sum on this. So just write down. 1 second. If the long-term capital gain says rupees 5 lakh, if the long-term capital gain is say rupees 5 lakhs, right? And the cost of house is rupees 7 lakh, and the cost of new house purchased is rupees 7 lakhs. If the cost of new house purchase is rupees 7 lakh, and in that particular case, what will be the amount exempted? So the amount exempted will be rupees 5 lakh, right? So if the long-term capital gain is 5 lakh and the cost of new house is 7 lakh, the entire long-term capital gain of rupees 5 lakh would be exempted. Clear? In this example is clear, right? Now, if the long-term capital gain is rupees 5 lakh and say I take this as the cost of purchase as say rupees 3 lakh, instead of 7 lakh, then only 3 lakh will be exempt. Only 3 lakh would be exempt, right? So if 3 lakh is exempt, then the long-term capital gain will be taxable, right? 2 lakh will be taxable at the rate of 20%. Now, if say for example, this asset is transferred before 3 years from the date of acquisition. If this asset is transferred within 3 years from the date of acquisition, then how will you compute the capital gain? So in that very case, say for example, considering this 7 lakhs only, right? What you will do is, say you transfer it for 10 lakhs. So full value of consideration 10 lakhs minus cost of acquisition 7 lakh. You will reduce from cost of acquisition the amount of exemption claimed earlier. So you will only allow 2 lakh to be reduced. So 8 lakh will be your capital gain. 8 lakh will be your capital gain. Is it clear? How will you charge to tax the exemption if it has been revoked? Clear? Any doubts with respect to this? Any doubts? Ramya, if the assessee has invested capital gain in another house property but also clone, then can he claim deduction under section 80C? Yes, he can, because under 80C, he get the deduction of the stamp duty value as well as the principal amount, right? So principal amount of house property, he can claim it as deduction as well as the stamp duty value of the house property. Clear, Ramya? Any other doubt? Any other doubt? Did you understand this well? Ramaya, you are asking that with respect to the slump sale, if the net worth is negative. So if net worth is negative, Ramaya, in that case, the negative amount you will reduce to determine the capital gain. What will happen? Negative will become positive. So did you understand, Ramaya? So for slump sale, how do we do it? For slump sale, Ramaya, we do consideration minus net worth, right? So this will be negative net worth. This will become positive. So this will become consideration plus net worth. Consideration plus net worth. Clear, Ramaya? This has been as per the decision of income tax tribunal, that if the net worth is negative, then the negative amount shall be reduced, which will eventually make the figure positive. Clear, Ramaya? Even in case we have net worth figure under demerger also, if you remember, where we do take the net worth as the denominator to determine the cost of acquisition of the resulting company shares. There, if the net worth is negative, you will take it as nil. There, if the net worth is negative, you will take it as nil. Here, you will take the net worth negative figure only, which will ultimately yield into a positive answer. Clear, Ramya? Any other doubt? Yes, Padmanaban, it is only for residential building and not commercial building. You are right. Sumit, you are asking that cost incurred for construction before transfer, whether section 54 exemption would be available. So construction must be completed within the 3 years period, right? It can be started earlier, so you can claim that. There are decisions with respect to that. The construction should be completed within 3 years from the date of transfer. Clear, Sumit? Any other doubt? Okay. So let's proceed further then. Next is section 54B. Section 54B, what does it say? It talks about transfer of agricultural land used for agricultural purposes by individual or his parents 2 years prior to date of transfer. 2 years prior to date of transfer. So 54B talks about agricultural land, right? So what is the eligible asset for that to be purchased? Rural or urban agricultural land. Rural, urban agricultural land. Right? What would be the gain? Long term or short term? Both. Both are eligible. Long term gain or short term gain, both are eligible. And what is the timeline for the investment? 2 years. Within 2 years from the date of transfer. And exempt amount will be same, lower of capital gain or investment amount. Lock-in period is 3 years from the date of acquisition. And if you violate the lock-in period or transfer the asset, then the cost of acquisition, the capital gain exemption amount will be reduced, same like 54. So same like section 54. So tell me one thing now. If the assessee invests the capital gain in rural agricultural land and transfers within 3 years, whether the capital gain would arise. So if the assessee transfer within 3 years, the capital gain, transfer within 3 years a new asset, and the new asset wherein he had invested was rural agricultural land, then in that case, whether capital gain will arise, whether the exemption will be revoked in that case. What is your answer quickly in your chat box? What is your answer? Quickly in the chat boxes, whether there will be any capital gain. Ramaya, correct? Why, Sumit, you are saying that? Any answer, Anjali? No, Anjali, not the correct answer. Correct, Ambika. Perfect answer. So in this case, if you see, the capital asset is rural agricultural land, the new asset. If you sell rural agricultural land, it is not considered as capital asset itself. So that will not result in any capital gains if you transfer the capital asset within 3 years. Exemption will be revoked. That's a different scenario. But there will not be any capital gains because rural agricultural land is not considered as capital asset. Are you clear with this? Is it clear? Shall we proceed to the third 54 series exemption? (54D). What is that? What is that? So first thing, sorry, let me tell you about this is 54 GB is only available for individual or HUF. Similarly, is the case with section 54. Individual or HUF. Right? And the third one which we are talking about, 54D, is any person. And what does it talk about? Compulsorily acquired land, compulsorily acquired land or building forming part of an industrial undertaking. By the government used for industrial purposes for 2 years prior to transfer. For 2 years prior to transfer. What you have to acquire? Land or building, again used for industrial purpose. So what is the asset which you have to sell? Compulsorily acquired land or building. It should be compulsorily acquired, forming part of an industrial industrial undertaking by the government used for industrial purposes for 2 years prior to the date of transfer. It can be short-term or long-term capital gain. What you have to acquire in return is land or building for industrial purpose. What is the time limit? What is the time limit? Purchase within 3 years from date of transfer, or construction within 3 years from date of transfer. So purchase or construction within 3 years from the date of transfer. What will be exempted? Again, lower of capital gain or amount invested. Capital gain or amount invested. What is the lock-in period? Three years from date of acquisition or construction. 3 years from the date of acquisition or construction. Clear? If you violate that, if you sell the new asset, again same consequences as 54. Clear? Any doubt till now? Any doubt? Remaya, I just clarified 54 and 54B. Any other doubt? Leela, you are asking on violation of conditions. What is the implication in shareholder's hand in case of conversion of sole proprietary concern into company? Right. So we discussed today. Here, what will happen if you violate the conditions of 13? Right? What we had discussed that time, that the fair market value, the excess of fair market value or on the date of conversion, the excess of fair market value on the date of conversion over the cost will be considered as capital gain, right? In the year in which condition is violated. Right, Leela? So that's what we had discussed. Clear, Leela? Ambika, I just now mentioned capital, how the capital gain would be revoked in case of 54B on sale of rural agricultural land. So, the exemption which you have claimed earlier, that will get revoked, right? As in, the exemption which you have claimed earlier, in that year, the exemption will get revoked. And when you sell off that asset, there will not be any capital gains chargeable to tax. Right, Leela? Right, Ambika? The exemption claimed earlier will get revoked. In that year, in that return, what you have filed, you would have claimed exemption. You will not get that exemption. When assessment happened for that particular year. Clear, Ambika? Any other doubt? Vipin, what should I explain once again? What do you want me to explain, Vipin? Okay, let's proceed further then. Next is section 54 EC. Again, this is for any person. This is for any person. And what is that? What does 54 EC says? 54 EC says what should be transferred? Only long-term capital asset being land or building or both. Long-term capital asset being land or building or both. And what should be purchased in return? What is the eligible asset? Bonds of NHAI Rural Electrification Corporation Limited. Time limit for purchasing is 6 months from the date of transfer. Exempted amount in this case would be lower of exempted amount in this case would be lower of investment amount or capital gain. Here there is a restriction. Maximum exemption can be rupees 50 lakhs. The maximum exemption can be rupees 50 lakhs. Clear? What is the lock-in period? Five years from date of acquisition. The lock-in period is 5 years from the date of acquisition. And in case you violate the lock-in period, here it is little different. What does it say? In case of transfer or conversion of the bonds, or if you lend those bonds, or like if you mortgage those bonds and obtain the loan against that, right? So not only when you transfer the bonds, but also when you obtain the loan by mortgaging those bonds, then in that case, before the expiry of 5 years from the date of acquisition, the capital gain exempted earlier shall be taxed as long-term capital gain. So here, capital gain exempted earlier will be taxed as long-term capital gain in the year of violation. Is it clear? Now tell me one thing. What if it is a case of, what if it is a case of a building on which I have claimed a depreciation and I have sold that building? It was forming part of a block of asset. I was owning that building. I was claiming depreciation on that because I was using it for my business. And then I'm selling off that entire block. As you know, on sale of depreciable asset, it is considered as short-term capital gain. But the building was used for more than 24 months. Whether in that case, can you avail 54EC exemption? My question to you is, if I have a building which was depreciable asset, which I have transferred, always on the depreciable asset, it's considered as short-term capital gain, but I have used the building for more than 24 months, then in that case, whether you can claim 54EC exemption. What do you think? Muthalakshmi, for 54D, the lock-in period starts from the date of acquisition or construction. Acquisition or construction, like you have to purchase the land or building for industrial purpose within 3 years, right? So it starts from the date of acquisition or construction. Clear, Muthalakshmi? Padmanabhan, if the LTCA is sold within 3 years, will the STCG be taxed in the assessment year relevant to the year of sale of asset or retrospectively? So first of all, if the LTCA is sold, I think you are doing some confusion in writing. You mean the new asset, if it is sold within 3 years, then the STCG will be taxed in the year of sale of asset. What is your answer for this? Ramaya, you are asking how can 54D include STCG, as it is mentioned that the asset be used for 2 years for industrial purpose. And you are right that immovable property takes 24 months to be LTCA. You are correct. Immovable property, the period of holding is any which ways 24 months and then it becomes a long-term capital asset. But earlier, the provision was 36 years or 36 months. So this particular provision has not been changed to say only long term. This has been kept like long term or short term, because earlier it was like that. So you're correct, only long term will be here, because any which ways the asset, if it is held for more than 24 months, it will become long term capital asset. Right, Ramya? Ambika, I didn't understand your question. In 54 also there's a residential land or building. How it will differ? Differ with what, Ambika? Sumit, right? What is the answer for current question? What I had asked? Ambika, your answer is correct, but the reasoning is not correct. Whether 54EC will apply on the sale of building, which is a depreciable asset but used for more than 24 months. What is your answers? Ambika, you can claim 54 as well as 54EC. But 54EC does not talk about residential house property. whereas 54 talks about residential house property. So it is on you. If you want to claim 54, you can claim 54. If you want to claim 54 EC, you can claim 54 EC also. There is another provision which is 54F also. Clear, Ambika? Which I'll talk in just a while. What is the answer for this? So in this case, let's understand one thing. Let's understand one thing here. Here, if you see, what I've said is the building is a depreciable asset. So that is why the gain will always be short-term capital gain. Correct. According to that, there should not be the exemption under section 54 EC claimed. But 54 EC does not say the gain should be long-term or short-term. 54 EC says that the asset should be a long-term capital asset. So even though the gain would be short-term on sale of depreciable asset being building, but if the asset is a long-term in nature, then you can claim 54 EC. So in our example, building was a long-term capital asset, right? Therefore, we can claim 54 EC on sale of depreciable building. Is it clear? So we can claim on sale of depreciable building. Clear? Next is Next is 54F. What is section 54F? It is available for individual or HUF. Correct? Individual or HUF. Again, long-term capital asset other than a residential house property. So LTCA other than a residential house property is covered under section 54F. What does 54F says? That what should be the asset transfer? Residential house other than a residential house property, any long-term capital asset. It can be sale of plot of land also, which should not be used for residential purpose. What you have to purchase in return? What you have to purchase in return? You have to purchase only one residential house property in India. So 54 was house property for a house property. 54F is for other than house property for a house property. Are you getting the difference between 54 and 54F? 54 was house property in return of a house property. Whereas 54F is for house property, other than house property for a house property. Are you clear? So 54F shall only be available where 54F, or I should say 54F will not be available if SC owns more than one residential house property on date of transfer. So 54F will not be available if the SSC owns more than one house property on date of transfer. Clear? Also, assessee purchases another residential house other than new house acquired within 2 years from date of transfer, or constructs new residential house within 3 years from date of transfer. So 54F will not be available if you have more than one residential house property on the date of transfer, plus if you purchase another residential house within 2 years from the date of transfer, or constructs new house within 3 years from the date of transfer, then 54F will not be available to you. Are you clear with this? Right? So 54F will only be available when you do not have any house property, like you exchange other than house property for a house property. Clear? Is it clear? Any doubt till now? So assessee should not purchase any residential house within a period of 2 years, or construct any other residential house within a period of 3 years. Clear? So only one residential house. In 54 you could have 2 residential house, but in 54 you have only one residential house which you could purchase. Right? Clear till now? Then what is the timeline for purchasing or construction of house property in India? What is the timeline? Timeline is same as 54. Purchase 1 year prior or 2 years from the date of transfer, and construction within 3 years from date of transfer. Here it is little bit different how the capital gain exemption will be computed. So it will be investment amount into long-term capital gain divided by net sale consideration. Unlike we had lower of capital gain or investment amount, here you will have investment amount into long-term capital gain divided by net sale consideration. Is it clear? Then what is the lock-in period? Three years is the lock-in period here. For violation, same as 54 EC. What did 54 EC violation says? That if the asset is sold within 3 years, then in that case what will happen is the capital gain amount exempted earlier will be taxed as long-term capital gain in the year of violation. Clear? Any doubts till now? Any doubts? Did you understand till now? Ambika 54 includes plot of land without building, but then it should be a residential house property. How can only plot be a residential house property? You cannot live on only a residential house property, Ambika. Ramaya, difference between 54 EC and what? Ambika, other than new house property acquired means you should not have any other house and other than the one you have newly acquired. Ramaya, I didn't get your question. 54 EC applies only an actual transfer, meaning what? What do you mean by that? Any other doubts? Yes, Anjali, I will give. I will give the question to you to solve. Any other doubt? Sumit, you've asked whether exemption under section 54F section 54F can be claimed in case where assessee acquired new residential house in wife name. So, Sumit, let me tell you, there is a Delhi High Court judgment in the case of Kamal Wahal, wherein it was held that assessee is entitled to claim exemption under section 54F in respect of the sale proceeds of capital asset for investment in house property, residential house property in the name of his wife. So the Delhi High Court had allowed the deduction to the assessee, wherein he had invested the amount in the name of his wife. Clear, Sumit? Muthulakshmi, yes, you can. Ramaya, these are two options which you get, 54EC and 54F. So if you want, you can put up in bonds, because see, putting up in a house property is a very big decision rather than putting in bonds. It is very easier to purchase the bonds worth of smaller value, but putting in a house property is a very big amount. So these are two options given, 54EC and 54F. Clear, Ramaya? Any other doubt? Any other doubt? Okay, let's proceed further. We will solve some on these. But let me just first finish the exemption parts. Okay. Next is section 54G. It is any person. 54G is any person. Again, capital gain may be long term or short term. Again, more specifically, it will be long term. What is the asset which should be transferred? Land or building or any rights therein or plant and machinery transferred in order to shift an industrial undertaking from an urban area to any other area other than urban area. So basically it says shifting of land or building or plant and machinery from urban area to rural area. And for that purpose, you have transferred, right? So 54D was with respect to compulsorily acquire land or building forming part of an industrial undertaking. Here, what is the case? Land and building or plant and machinery transferred in order to shift an industrial undertaking from rural area to from urban area to rural area. So here you are transferring the land because you are shifting your undertaking from urban area to a rural area. So what is the condition here? What should be purchased? Asset to be acquired, new machinery or plant or land and building for industrial purposes in a rural area to which industrial undertaking is shifted, or expenses incurred on shifting, even that is eligible. Clear? Time limit is 1 year prior or within 3 years from the date of transfer. 1 year prior or within 3 years from the date of transfer. Capital gain exemption is lower of invested amount or capital gain. Clear? What is the lock-in period here? 3 years from date of transfer. Violation of this will result into same as 54, meaning the exemption amount will get revoked and the exempted amount earlier will be reduced from cost of acquisition. Clear? Is it clear? Next one is also similar. Section 54GA. What is section 54GA? Available to any person. Nature of asset, short-term or long-term capital gain. What is the asset which is to be sold? Land and building or any rights therein or plant and machinery transferred in order to shift an industrial undertaking from an urban area to special economic zone, whether in urban or rural area. Clear? So if you transfer your land in order to shift your undertaking from urban area to SEZ in urban or rural area, you get exemption under section 54GA. What is the eligible asset? New machinery or plant or land and building for industrial purposes, or expenditure on shifting. Same. Lock-in period is also same as 54G. Lock-in period is also same, right? 1 year prior or 3 years later. Clear? And if you violate the condition within 3 years from the date of transfer, then same result, capital gain exemption will be revoked and that exempted amount will be reduced from cost of acquisition. But what will be the exemption limit? Exemption will be investment into LTCG divided by net sale consideration. So unlike 54, where it is lower of capital gain or exempted capital gain or investment amount, here it will be investment into LTCG divided by net sale consideration. Clear? Any doubt till now? Any doubts you have? Padmanabhan, you are asking investment partly in 54EC and 54F is allowed. So that maximum investment of 50 lakh is also not breached. But if you do not breach, if you reach 50 lakh limit, you can also claim in 54F. But 54 has already a higher limit. So why you are saying like that, like you want to go partly in this and that? Okay, let's proceed further. Next section. Last one, but very important. 54 GB. It is only for individual or HF. Now, what is this saying? Long-term capital gain on residential house property. Including plot of land between 1/4/13, 31st March 21. Again, for residential house property are 54 GB. So what are the exemptions for residential house property? One is 54 house property for house property. Second is 54 EC. You sell house property, you purchase bonds. Third is 54 GB. You sell house property between 1/4/13 to 31st March 21 and you invest in eligible asset is equity shares of eligible company, which should utilize the amount for purchase of plant and machinery. So if you sell off the residential house property and you invest that amount in equity shares of eligible company, which then utilizes that amount received from subscription of equity shares. For purchase of plant and machinery, you will get exemption under 54 GB. What is the time limit for acquiring the shares? On or before due date of return of income. On or before the due date of filing of return of income. Also, for investment in machinery by company, due date is 1 year from date of subscription in equity shares by SSE. So you need to invest in that company within on or before due date of filing ROI. The company needs to invest in plant and machinery within 1 year from the date of subscription in equity shares by the SSE. Clear? So there are timelines set for both. What is the amount of capital gain exempt? Exemption will be LTCG into amount investment in plant and machinery divided by net sale consideration. Amount invested in plant and machinery divided by net sale consideration. Now, what is an eligible company? What is an eligible company? Eligible company means incorporated in the financial year in which capital gain arises, incorporated in the financial year in which capital gain arises, or in following year on or before due date of filing ROI by individual or HUF. So due date of filing ROI for whom? Individual or HUF. Right? Due date not for the company but before the due date of filing return of income for individual or HUF, which is 31st July usually. It should be engaged in business of manufacturing of any article or thing. It should be engaged in the business of manufacturing. Third, a company in which individual or HUF should hold greater than 25%, greater than equal 25% of share capital or voting power after subscription in shares. Clear? Is it clear? Company should qualify as micro, small and medium enterprise, MSME. The company should be involved in innovation or technology driven processes. Should be incorporated between 1/4/16 to 31st March 21. 1/4/16 to 31st March 21. Clear? It also should have turnover less than equal to rupees 25 crore. Is it clear? So this is to give an impetus to the startups. This provision has been introduced that if you sell residential house property And if you invest the amount in the shares of equity shares of an eligible company, which is a startup, then you will get this exemption under section 54, under section 54 EE, oh sorry, 54 GB. Clear? Also, the investment amount has to be in plant and machinery. So plant and machinery should not include any machinery which before the installation was used whether within or outside India by any other person. So plant and machinery should not include second-hand plant and machinery. Right? Any machinery or plant installed in office premises or residential house, office appliances like computers. However, this condition shall not apply for technology driven startup. So office appliances may be taken as plant and machinery for technology driven startup, as their main business operates, their main plant and machinery is computer itself. Clear? Any vehicle. Clear? What is the lock-in period for this? 3 years from date of acquisition. And if the shares of the new company are transferred within the 3 years, then the capital gain exempted shall be taxed as long-term capital gain. Clear? Should be taxed as long-term capital gain. Is it clear? Any doubts till now? Remember, there is no such prohibition under 54G and 54GA that the second-hand plant and machinery purchase cannot be taken as deduction. Ambika, there are these certificates which are or forms to be filed for claiming these exemptions from, and if the company files, it can be easily verified from that. Clear, Ambika? Any other doubt? Any other doubt? Did you understand this well? Shall we solve questions on these? Let's solve few questions on these. Okay. So I'm opening up the ICAI question only. So this is the question. Hari has acquired a residential house property in Delhi on 15th April 2002 for rupees 9 lakh. He decided to sell the same on 3rd May 2005 to Miss Pari. An advance of 25,000 was taken from her. Balance money was not paid by Pari and Hari had forfeited the entire sum. On 3rd June, he sold his house to Mr. Suri for 40 lakh. On 4th April, he had purchased a residential house in Delhi for 8 lakh, where he was staying with family on rent for the last 5 years and paid the full amount as per purchase agreement. However, Hari does not possess any legal title till 31st March 21, as such transfer was not registered with the registration authority. Hari purchased another old house in Chennai on 14th October from Mr. X, an Indian resident, by paying 5 lakh, and the purchase was registered with the appropriate authority. Determine the taxable capital gain for AY 21-22. Giving you 5 minutes time, tell me the answer for this. What will be the answer for this? What is the answer? Quickly tell me. Right, Sumit? What is the answer? Anybody else? Quickly compute the answer. No, Ambika. Ramaya, correct? Ambika, you've just computed the capital gain, but you have not taken into consideration the exemptions. Anjali, no. Not the correct answer. Okay, let's see together. Let's solve it together, this sum. So here they have said Hari has acquired the residential house in Delhi on 15th April for 9 lakh and decided to sell the same, for which he had taken advance of 25,000. This advance, will it reduce the cost of acquisition? Will it reduce the cost of acquisition when this advance was taken in 2005? Right? So what I taught you was that if it is before 1/4/2014, you will reduce it from cost of acquisition. If it is after 1/4/2014, you will tax it as income from other sources. In this case, it is before 1/4/2014. So therefore, you will reduce this advance from the cost of acquisition. Answer clear? So from 9 lakh, this will be reduced. Then on 3rd June, he sold the house for rupees 40 lakh. And 40 lakh will be a full value of consideration. There is no stamp duty value given in this question, right? Then what they say is less index cost of acquisition, that will be 9 lakh minus 25,000, and then you will apply the indexation. See here, cost of acquisition 9 lakh, less advance taken and forfeited 25,000, 8,75,000, that you will index it. Clear? Then they say the amount has been invested for 8 lakhs has been invested in a house property, and then another 5 lakh has been invested in another house property at Chennai. So both of these amounts you will claim the deduction because here it is less than 2 crore. Here the capital gain amount is less than 2 crore. So therefore in that case, Mr. Hari can claim the exemption in respect of 2 residential houses situated in India at his option. And if he claims in this particular year, in any other year, he will not be entitled to claim this option of taking 2 house properties as deduction. Clear? Is this clear? Here 54 series exemption can be claimed because a residential house has been purchased within the 2 years from the date of transfer. And one was purchased within 1 year before the date of transfer. So the one house which he's saying was purchased on 4th April 2020. He sold the house on 3rd June. So it is within 1 year. The second he purchased on 14th October 2020, which is also within 2 years from the date of transfer. Clear? So also, though he does not possess any legal title till 31st March 2021, since the transfer was not registered. However, for claiming the deduction under section 54, the holding of legal title is not necessary. Clear? So if he has paid the full consideration and if he has entered into an agreement, then there is no problem. Even if the registration has not been done, it is okay. He can claim the deduction. Are you clear with this question? Any doubt? No, Raman, the answer is not correct. Ambika, yes. Now you have done correctly. Shall we solve one more question? Let's solve one more ICAI question itself. Let me open up that question. Just give me a moment. Just give me one moment. GB. Let's solve this question. Gamma Limited located, not 54 GB, sorry. This is on 54G. Gamma located to shift its industrial undertaking to non-urban area. Company assets and acquired new assets in the process of. Relevant details are as follows: land, building, plant and machinery, and furniture. Sale proceeds, index cost of acquisition, WDV, cost of new assets for the purpose of business in new place. Compute the capital gain. So I'm giving you 5 minutes time. Tell me the answers. What is the answer? Right, Sumit. Perfect answer. Yes, Ambika. Yes, Ramaya. Correct answer. Let's solve it together. Yes, Ambika. So here if you see, again very simple question, only one adjustment is there. Land, building, plant and machinery, furniture. So furniture 54G will not be available on this case. Furniture does not qualify as an eligible asset. So in this case, we will not take into consideration furniture which is purchased as well as which is sold. Now you will compute the capital gain. Land, building, plant and machinery and furniture. So rest of the assets are short-term capital gains because those are depreciable asset. Only land is non-depreciable, which will qualify as long-term capital gain. Now, if you see the amount invested is 25 lakh, we have to consider only these three, right? 4, 7 and 17 lakh. Clear? Now, if you see the entire 25 lakhs, if you see here 28 lakhs, sorry, if you see 25 lakh is the short-term capital gain on building, plant and machinery combined both. And the incidence of long-term capital gain is always higher than the short-term, incidence of the short-term capital gain is higher than long-term capital gain. So therefore, it is not necessary that if you have purchased building, you have to adjust only against building. You can claim purchase of building against plant and machinery also, against building also. So First 25 lakh is utilized towards purchase of building and plant and machinery, and the balance is utilized towards land. So the short-term capital gain on building and plant and machinery comes to 25 lakh. So that will be considered as utilized first from the 28 lakhs which is invested, and the balance 3 lakh will be adjusted against sale of land. So 1 lakh will be taxable as long-term capital gain, and 1 lakh on sale of furniture will be taxable as short-term capital gain. Short-term capital gain at normal rates of tax at the slab rate, and the long-term will be at the rate of 20%. Is it clear? Any doubts till now? Anjali, did you understand this now? Land is only one. Raman, did you understand this? Is it clear? Any doubts with respect to this question? If not, let's take a small break of 15 minutes and then we get back to income from other sources. Meanwhile, if you have any doubts, you can just ask me. We can take a short break for 15 minutes then, and we'll meet after 15 minutes. Okay. Yes. So any doubts further? Ramya, you are asking me two doubts. First is capital asset transferred as stock in trade by the holding company. I didn't get it. If it's a capital asset, it cannot be stock in trade, Ramya. Only if it is a capital asset, then 47.4 will apply. If it is stock in trade, then 47.4 will not apply. And when the stock in trade is sold by the subsidiary, so once you transfer it to the subsidiary, then it is stock in trade for subsidiary, right? It is not capital asset converted into stock in trade for subsidiary. So when the holding company will convert it and when it will sell to the subsidiary, it will transfer to the subsidiary, then 45.2 will apply on holding company. It will not apply in the hands of subsidiary. Clear, Ramya? And you're asking Indian company, foreign company amalgamated to form a foreign company. Is it exempt from transfer? No, Ramya. It's not exempt from transfer. Any other doubts? Okay, if not, we can start with income from other sources. Are you clear with the capital gains chapter? Just reply me in your chat boxes that if you have understood this chapter well. Or do you need me to cover something else apart from this? Before we start off with the capital income from other sources. Please reply to me in the chat boxes. Are you clear with the capital gain concepts? Specifically explain in 15. Can you be specific about that? Please reply me in your chat boxes very quickly before we proceed on to income from other sources. Okay, it is clear, right? Okay, so let's income from other sources. Now, income from other sources could be divided into segments. One for the income always taxed under EFOS because this is a residual head. And second, income classified as EFOS if not taxed under any other head. So what are the income classified as EFOS if not taxed under any other head? Let's look at it. Interest on securities. So interest income is chargeable under EFOS only if it is not chargeable under the head PGBP. Interest income is chargeable to EFOS if it is not covered under PGBP. If it can be taxed under PGBP, then it will not be taxed as EFOS. Interest income taxable under PGBP if it is on account of any business expediency, then it will not get classified here. Are you clear? Second, employees' contribution to provident fund or other fund, if not taxed under PGBP. So if you do not pay the employee's contribution on time, it is considered as your PGBP income, right? So if it is considered as your PGBP income, and then also get deduction if you make the payment on filing of return of income, right? But in case if it is not in related to, or it is not related to your business or profession, then in that it will be covered under income from other sources. It will be covered under interest income from other, under the head PG, then it will be covered under EFOS. Is it clear? Next is income from letting out plant and machinery or furniture. So if it is on account of business expediency, then PGBP. In other cases, it will be EFOS. Alright? So income from letting of plant and machinery, if it is on account of business expediency, profession, profit and gains from business or profession. If it is in the case that it is other cases not falling for business expediency, then in that particular case, it will be income from other sources. Clear? Is it clear? Then the next is income from leasing. So if leasing is business of assessee, leasing business, then it will be PGBP. If it is leased due to temporary layoff, again PGBP. However, if it is leased due to closure of business, then EFOS. Remember in the basic concepts class, we had dealt with this kind of case law, that if it is due to the fact that business is temporarily shut down, and to reduce my loss, I am leasing out my assets. So if that is the case, then in that particular case, what will happen? It will be considered as business income. However, if it is due to closure of the business, if I am leasing it off, then in that particular case, it will be considered as income from other sources. Clear? Clear? Now, I'm putting a question to you, but before that, last one point under this. Then I'll ask you a question for this. Keyman insurance policy. If it is from employer, if employer receives the proceeds of Keyman insurance policy, it is taxable under PGBP. If employee receives, then salary. If family of employee receives scheme and insurance policy, then income from other sources. Is it clear? Any doubts till now? Okay. So let me ask you a question. Say, for example, the assessee company comes out with issue of shares. Now, usually if you see when the IPO is issued, the amount which is received for share application is deposited in a bank, right? So on that deposited money, the assessee earns some interest on share application money which was kept in the bank account till the time the shares are allotted. The amount earns some interest from the bank. To you is the assessee said that this amount is under the head income from other sources. But he subsequently changed his stand that against the public issue expenses, which generally allowed as deduction under section 35D under the head business income, you get a 1/5 deduction of expenses on raising the share capital. Now the assessee said against those public issue expenses, this interest income which is earned should be set off. Now my question to you is whether the interest on deposits for application money received sources or this have been taxed on GDP. What do you think is the answer according to you? What do you think is the answer, whether it is income from other sources or PGBP? What do you think? Whether it could be reduced against public issue expense? Please tell me the answers quickly. Why, Anjali? Yes, Ramaya, perfect. Tell me the answers quickly. So in this case, it was a case of Henkel's pick assessee. Also in the similar case was there of Sri Rama Multitech Limited. This case reached to Supreme Court and Supreme Court clearly said it that the assessee was required to keep the share application money in a separate account till the allotment of shares. Now, this money never belongs to the assessee, as assessee has to return or refund the amount to the unsuccessful applicant not allotted any shares. So therefore, the interest earned was not something which was with the agenda of earning, so the amount which was kept in the bank account was not with the agenda of earning interest, but it was required statutorily. The interest which was earned was inextricably linked with the requirement of raising share capital. Right? So any surplus money deposited in the bank is liable to be taxed under E-force if it is earning interest. However, in this particular case, the share application money was not deposited to earn money, but to comply with the statutory obligation. So the interest income which was earned was related to the share capital, and therefore it will be reduced from the public issue expenditure and not taxed as income from other sources. Are you clear? Is it clear? So therefore, this interest amount will not be taxed as income from other sources, but will be reduced from the capital gain, will be reduced from the public expenditure account. Clear? Is it clear? Any doubt? Any doubt with respect to this? Next question to you is, now there was this one assessee whose agricultural lands were compulsorily acquired by the government. Now the assessee went and challenged the compensation which was awarded to him. He won the challenge in the district court. He won the challenge, and some additional compensation was given by the government to the assessee, along with some interest amount under Land Acquisition Act. Now, the question of assessee was that this particular interest amount, whether it is taxable as income from other sources or it is taxable as capital gain. What do you think? What do you think in this situation? What do you think, whether it is taxable as capital gain or income from other sources? Give me the answers in chat boxes quickly. Whether the interest received on enhanced compensation is taxable as income from other sources or under the head capital gain. Why, Raman? Any specific reason to it? Yes, Ramaya, correct. You are correct, Ramaya. So in this particular case, again, this was a case in the name of Movalya Balabhai. Movalya Balabhai case. This is a High Court case. Now, what the High Court said in this case was that here the assessee basically received the interest under the Land Acquisition Act, which represents the enhanced value of land. So the court said that the assessee received something in the name of interest, but it represents the enhanced value of land itself. and therefore it is in the nature of compensation only because he received less compensation. So therefore he was paid additional compensation plus interest. Sorry. And therefore this interest partakes the character of compensation and therefore will be taxable under the head capital gains. Now, how would you distinguish the interest which will be taxable under EFOS on enhanced compensation vis-a-vis the one which is taxable under the head capital gain? Now, this interest was received because less compensation was awarded to him. So, it was in the nature of additional compensation. But if interest is received on account of delayed in payment of compensation, then that will be covered under EFOS. So are you understanding the difference between the two? Are you understanding the difference between the two? So if interest is received on delayed compensation, EFOS. If interest is received as additional compensation, capital gains. Is it clear? Any doubts till now? Is it clear? Okay, so let's proceed further. Now, this is something which I said, income classified as EFOS if it is not being taxed under any other head. We saw if it is taxed under any other head, it will not come under EFOS. It will only come under EFOS if it is not taxed under any other head. Now, there are some incomes which are always taxed in EFOS, irrespective of anything. Which are those incomes? First, dividend. First is dividend. Let's discuss about dividend. 5621. Now, dividend includes interim dividend also, right? Dividend includes interim dividend also. Now, tell me one thing. How is the taxability of dividend from this year? I told you while I was teaching international tax class also. How will be the taxability of dividend? Do you remember something? So, dividend is taxable in the hands of shareholder now. Earlier, dividend distribution tax was imposed on the levied on the companies. Now, DDT has been abolished and all of the dividends are taxable in the hands of shareholders. Is it clear? Now, we'll discuss about deemed dividend. We'll discuss about deemed dividend. Right? So, deemed dividend, let's classify it into 222A, 222B, 222C, 222D, and 222E. Right? So first of all, 222A. What does it say? Distribution of assets by the company to its shareholders is covered under 222A. So distribution of assets by the company to its shareholder attract deemed dividend provisions. 222B is regarding distribution by a company by way of debentures, debenture stock, deposit certificates in any form, or bonus shares to preference shareholder. Whether issue of bonus shares to equity shareholders will be covered under deemed dividend provision, the answer is no. Only issue of bonus shares to the preference shareholder is covered under deemed dividend under section 222B. Clear? 222C we have already dealt while we were dealing with liquidation 46.1 and 46.2. What is that? Distribution by a company made to its shareholders on liquidation. On liquidation. Remember that. And 222D is distribution by a company made to its shareholder on reduction of share capital. On reduction of share capital. Clear? Now, E I will cover later. This will be all of these distribution of assets to shareholder. So if you distribute the dividend in cash, that is something covered by normal dividend provision. It is not deemed dividend. If you distribute in kind, if you release your assets to the shareholder, that is covered under 222A. So distribution of assets by the company to its shareholder is covered under 222A. Distribution by a company by way of debentures, issuing debentures to the shareholders or issuing bonus shares to the preference shareholders will be covered as deemed dividend. Distribution by a company to its shareholder on liquidation to the extent of accumulated profits, it is covered under 222C. Over and above accumulated profits will be taxable under 46.2. We had seen how in 46.2 we used to reduce from the cost of acquisition deemed dividend taxed under 222C. Remember that? 222D. Distribution by a company made to the shareholder on reduction of share capital. Now all of these are to the extent of accumulated profits, whether capitalized or not. To the extent of accumulated profits, whether capitalized or not. And accumulated profits are to be considered till the date of distribution of dividend or liquidation of company. Is it clear? Is it clear till now? Any doubts do you have? Any doubts? Did you understand this? So for liquidation, what we used to do is, we used to take FVC as money received plus FMV of the assets distributed minus deemed dividend under 222C. Do you remember in the capital gain class we had done while we were dealing with 46.2, right? And all of these are till the level of accumulated profits. They will be taxed as deemed dividend. Clear? Is it clear? Any doubts? Okay, if there are no further doubts, let's proceed to 222E. Now, what is 222E? Let's understand in detail. We'll solve a sum on this. What is 222E? A closely held company, if it gives loan or advances to shareholder holding not less than 10% of voting power as on date when such loan or advance is given, or to a concern in which such shareholder is a member or partner and has substantial interest which is greater than equal to 20% at any time during previous year, or to any person on behalf of such shareholder. Then 222E is attracted. Are you getting that? So if a closely held company, closely held companies with other than listed companies, gives loan or advances to a shareholder who has more than 10% voting power, or to a concern in which such shareholder has more than 20% interest and such shareholder is a member of partner of that concern. Concern includes even HUF. Concern includes even an HUF. Or it makes a payment to any other person on behalf of such shareholder, then that will be considered as deemed dividend to the extent of the accumulated profit, right? So it will be deemed dividend to the extent of accumulated profits. Now 222A to 222D had accumulated profits whether capitalized or not. Here excluding capitalized profits. Here you do not have capitalized profits. Clear? Clear? Now advances given in the nature of ordinary course of business, like suppose trade advance is given to creditor who is also a shareholder holding more than 10%. Whether that will be considered as deemed dividend? Answer is no. So trade advances and advances given in the nature of ordinary course of business will not be considered as deemed dividend. Is it clear? Is it clear? Because that is in the nature of ordinary course of business. There's a CBDT circular on that. Whether buyback of shares is considered as deemed dividend? Answer is no. Buyback of shares is not a deemed dividend transaction. Clear? Whether distribution of shares during demerger, that is considered as deemed dividend? Answer is no. That is specifically excluded from deemed dividend provision. Clear? Is it clear? Any doubts with respect to this? Shall we solve a question on this? Let's solve a question on this. Okay. Let me give you a question on this. One second. Just write it down. Balance sheet of A Private Limited. Liabilities, equity share capital 2 lakh, reserves and surplus 6.5 lakh, assets cash 8.25 lakh, P&L 25,000. On 1/4/20, A Private Limited gives loan of rupees 2 lakh to X holding 11% to Mr. X holding 11% voting power. On 2nd April 2019, Mr. X repays the loan to company. Sorry, on 2nd April 2020, Mr. X repays the loan to company. On 31st July 2020, A Private Limited gives loan of rupees 2 lakh to a firm in which Mr. Z is partner and holds a substantial interest of 20% on date of loan. On 30th September 2020, A Private Limited gives a loan of rupees 3 lakh to supervisor having salary of rupees 4K per month, who in turn advances said amount of loan to Mr. P, who holds 70% of paid up share capital of A. Discuss the taxability of 222E. So tell me the answer for this. I'm giving you 5 minutes time. What is the answer? What is the answer? Quickly tell me. Yes, Ramaya. Right answer. No, Anjali. Okay, let's solve it together. Here, what are the accumulated profits? 6.5 lakh minus 25,000. Right? So 6,25,000 is the accumulated profit. So first 2 lakh will be taxable in the hands of Mr. X. Repayment of amount doesn't matter because if you have given the loans, even if you have repaid, it will be considered as deemed dividend. Second, 2 lakh in the hands of a concern, 2 lakhs given to a concern in which the partner is substantially interested, it will be taxable in the hands of Mr. Z, right, who is the shareholder. So that 2 lakh amount will again be taxable. Then 3 lakh given to a supervisor on behalf of Mr. P will be taxable in the hands of Mr. P to the extent of the accumulated profits which are remaining, right? So accumulated profits are remaining is 2,25,000. So only 2,25,000 will be taxable as deemed dividend. Clear? The excess amount of rupees 75,000 shall be treated as loan. Clear? Is it clear? Is it clear? Here in the third case, on the loan amount, interest would be charged. If interest on the loans given is less than, or if the excess interest is paid, right? Here, A Private Limited has given the loan of rupees 3 lakh to supervisor. Then on that, the interest portion should also be charged. Otherwise, what will happen if the payment is being made of the interest by Mr. P? Then that interest payment will be disallowed under 40A2B, under 40A2 of PGBP section, wherein it says that it should be at the fair market value. In case if the payment is being made to a person who has a substantial interest, right? So in that case, 40A2 applies on the interest payment being made by Mr. interest payment made by Mr. P to the A Private Limited. Clear? Is this clear, sir? Let's proceed further. The second part, which is very substantial under EFOS, is, so we covered first year, which are specifically dealt with under EFOS. Right, incomes always taxed under EFOS. First was dividend. Second, winning from lottery, puzzles, crossword puzzles, race horses, right, card games is always taxable under income from other sources. Even if the distributor of lottery tickets receives the lottery amount, that will also be taxable under EFOS. That will also be taxable under EFOS, not under PGBP. Interest on compensation. Interest on compensation, enhanced compensation, is taxable under EFOS and 50% deduction is allowed. Remember, advance money forfeited, we just now saw, it is taxable under EFOS if received after 1/4/2014. Otherwise, if received before, it is reduced from cost of acquisition. Next, gifts received by all SSC. Now let's talk about the gifts. Gift taxation. Right? Now, how do we categorize the gifts? So 56 to 10 A talks about cash gifts greater than rupees 50K without consideration from any person other than your relatives, right? Or received on the occasion of marriage. So there are certain exceptions. If the gifts are received on the occasion of marriage or on the death of donor, right? Or under the will or inheritance from a relative, right? Or on the total or partial partition of HUF. Clear? So in that case, in that particular case, that will not be considered as gift. Clear? That will not be considered as gift. Then second is 56 to 10B. This is with respect to immovable property. So if received without consideration and stamp duty value greater than rupees 50,000 entire stamp duty value is taxable in the hands of recipient. Or for inadequate consideration, then SGV minus consideration is greater than 50,000 or 10% of consideration entire difference is taxable. So if immovable property being land or building is received without consideration, then the stamp duty value exceeds 50,000, then entire stamp duty value is taxable under 56(2)(10)(b). If it is received for inadequate consideration, then in that case, the stamp duty value minus your consideration, right, that will be taxable if it is greater than 50,000, the difference between stamp duty value and the sale consideration, or the difference between stamp duty value and sale consideration is greater than 10% of consideration. Why 10%? Why 10%? 10% is the tolerance band which we saw under 50C also. Do you remember that? The same amendment has been carried out under 56(2)(10) also. Clear? Is it clear? Then the third is, so if you receive the immovable property, so say for example, if the seller of the immovable property transfers at a value which is less than the stamp duty value, and the difference between sale consideration and stamp duty value exceeds 10% of consideration, then in that case, in the hands of seller under 50C, you will take SDV. In the hands of the recipient, you will take the income of difference between SDV and sale consideration as income under 56(2)(10). Clear? Here also, SDV as on which date is to be taken, date of registration or date of agreement. If both dates are different, it is to be taken on the date of agreement. If amount is received through account pay check or bank draft or ECS on or before the date of agreement. If amount is not received, then on the date of registration. Same provision like 50C. Clear? Third case, movable property. So movable property received without consideration and fair market value greater than rupees 50K. Entire fair market value. Or inadequate consideration, then FMV minus consideration. If it is greater than 50,000, then difference is taxable. Movable property meaning what? Shares and securities, jewelry, archaeological collection, drawings, any work of art, bullion, all that is taxable as movable property. Clear? Is it clear? Is it clear? Any doubt? Shares received at the time of amalgamation or demerger that are exempt from 56(2)(10). Clear? That are exempt from 56(2)(10). Now, tell me one thing. I'll give you a sum to solve, which you have to quickly solve. Just give me a moment. Yes. Let's solve a quickly sum on this. Give me answer very quickly about this. Mr. A, dealer in shares, received the following without consideration. Cash gift 75,000 on his anniversary. Bullion, the fair market value of 60,000 on his birthday. Plot of land at Faridabad on 1st July 2020, stamp duty value of which is rupees 5 lakh. Mr. B had purchased the land in 2009. Mr. A purchased from his friend Mr. C, who is a dealer in shares, 1000 shares of X Limited, 400 each, on 19 June, fair market value of which was 600 on that date. Mr. A sold these shares in the course of his business on 23rd June 2020. On 1st November, he took the possession of property booked by him 2 years back at 20 lakh. Stamp duty value as on 1st November was 32 lakh and the date of booking was 23 lakh. He had paid rupees 1 lakh by an account paid check as down payment on the date of booking. On 1st March, he sold the plot of land at Faridabad. Compute the income chargeable under the head income from other sources and capital gain. So tell me the answer. Tell me the answer for this. Also, one more important point to solve the answers. Just 1 second. So remember that 47 says transfer of gift, transfer under a gift is exempt, is not taxable, right? So therefore 49 says whenever you receive the gift, cost of acquisition would be cost to previous owner, right? Then period of holding under 242A says will be clubbed off the previous owner. Manjula Shah judgment says indexation will apply on clubbed period. That is when asset was held by previous owner, right? Indexation of that year. But if, say for example, the taxation is happening under 56(2)(10), where it is not a gift but transfer for inadequate consideration, then 49(4) applies and it says cost of acquisition will be FMV taxed under section 56(2)(10). Clear? And in that case, period of holding will not be clubbed. Is it clear? Period of holding will not be clubbed. Clear this much part? So before I give you the sum, did you understand this much part? Just solve the sum then and tell me the answer. Anjali, the interest part, I said that if Mr. P takes a loan, right? It's a loan to Mr. P. So Mr. P will have to pay the interest at the fair market value. Otherwise, the deduction if he claims under PGBP will not be allowed to him under 48(2). If you remember, 48(2) says related party transaction. The payments which are there under that should be at FMV. If it is not at FMV, it will be disallowed. Clear, Anjali? Yes, Anjali, indirect transfer of loan, meaning that if you make a payment on behalf of the shareholder to somebody else, that will also be covered under 222E. Did you get the answers? Yes, Ramaya, correct. Very nice. Shall we solve this sum together? Okay, let's solve it together. So first is cash gift on anniversary, whether that will be exempt, because if it's received on anniversary, the answer is no. So cash gift on anniversary received would be taxable for sure, because that is not an exempt gift and it exceeds 50,000, right? So that will be taxable. Second, bullion, the fair market value of which exceeds rupees 50,000 will also get taxed. If it's on birthday, that is not exempt. Plot of land at Faridabad will also be taxable since the stamp duty value exceeds 50,000, right? Then Mr. A purchased from friend who is dealer in shares 1,000 shares, and Mr. A is also a dealer. So for him, the shares are stock in trade. So if the stock in trade is received, that will not be considered under 56.210. Only the capital assets are covered under 56.210. If shares were capital assets, it would have been taxable. Your shares are stock in trade for Mr. A, then it will not be taxable under 56.210, right? Then on 1st November, he had taken the possession of immovable property, right? And stamp duty value we will take on the date of booking, or date of possession we'll take on date of booking, because here 1 lakh is received on the date of booking, right? And if you see the stamp duty value and the actual sale consideration, right, there is a difference of more than 10% of actual sale consideration, and it is also exceeding 50,000. So in that case, what will happen is, here the difference between the actual sale consideration and stamp duty value will also get taxed. Clear? So this will be your income from other sources. And when the plot of land is sold at Faridabad for rupees 7 lakh, 7 lakh minus what will be the cost of acquisition? Cost of acquisition will not be the cost at which he has purchased or the stamp duty value, but the price at which it is taxed under 56(2)(10). It is taxed at 5 lakhs. So 5 lakh will be the cost of acquisition as per section 49(4). Clear? That will be a capital gain amount. Is it clear? Anjali, did you understand? Clear? Okay. Let's deal with the last provision under EFOS. 56(2)(7)(b). 56(2)(7)(b). What does it say? Say, for example, a closely held company receives from a resident shareholder consideration for issue of shares, where the issue price exceeds the face value of shares. Where the issue price exceeds the face value of shares, then the amount will be taxable under section 56(2)(7)(b), which will be issue price consideration received minus fair market value. Minus the fair market value. This provision do not apply to category 1 and category 2 AIF and eligible startup and an eligible startup, right? So if a startup, there are certain conditions provided under the by the DIPP, right? So if that startup industry, they have notified certain conditions, Department of Industry and Investment Promotion Board, they have notified the conditions for an eligible startup. If a startup satisfies those conditions based on turnover requirement, based on the asset requirement, they will not be taxed under 56(2)(7)(b). This is for the recipient company. This is not for the company with, this is for the issuing company. So 56(2)(10) is for recipient of shares, right? If a person who receives the share. 56(2)(7)(b) is for issuing company, the one who is issuing the shares, if it receives the consideration less than FMB. Oh, sorry, if it receives the consideration greater than face value of the shares, right? And this will not apply for AIF and eligible startup. A startup who fails to satisfy any condition, then in that year, in the year of violation, what will happen? It will be taxable under section 56(2)(7)(b). Clear? It will be considered as deemed income under 56(2)(7)(b). Also, it will be considered that there was misreporting of income on which 200% penalty would be charged. 200% of the tax payable will be charged as the penalty. Clear? So, let me give you an illustration for this. Say, for example, there's company A, B, and C. Say consideration received on issue of share is, say, rupees 370, 330, and 290. Face value of share is 300, 300, and 300. Say fair market value is 350, 350, and 280. Number of shares 1 lakh, 2 lakh, and 3 lakh. Giving you 3 minutes time to tell me whether this will be taxable or not. Whether 5627B will be applicable on A and B and C. And in the first case, what will be the taxable amount? Quickly, very simple. Yes, Amaya, right. Whether in the first case 56(2)B is attracted. So if you see in the first case, consideration is 370, face value is 300. So yes, 5627B is applicable. And what will be the amount of taxability? 370 minus 350. 20 into 1 lakh shares. Whether in the second case 5627B is attracted, it is greater than 300. So yes. What will be the taxable amount here? Here the consideration is less than FMV. In the second case, the consideration is less than FMV, so nothing is taxable. In the third case, consideration is less than face value. So 5627B is not attracted. Are you clear with this? Is it clear? Any doubts? Any doubts? Did you understand this concept? Okay. The last one point is interest deduction. Interest deduction. So earlier, as I said, dividend was taxable in the hands of the company because DDT was levied, right? Now dividend is taxable in the hands of shareholder. So earlier when dividend was taxable in the hands of company, it used to be exempt in the hands of shareholder, right? So whatever interest expenditure was incurred for the purpose of earning dividend used to get disallowed under section 14A, if you remember. Now that 14A is no more applicable. So now if it is taxable in the hands of shareholder, the shareholder will get deduction under income from other sources because dividend is taxable under income from other sources up to 20% of dividend. So you will get a deduction of 20% of such income. You will get the deduction of interest expenditure incurred for earning the dividend income. Clear? So any doubts do you have? You can ask me now. If you want me to repeat any concept or any doubts do you have? Are the concepts very well clear? Did you understand everything? So shall we stop here for today if there are no further doubts? Because this is my last lecture for this series again. We may meet in the next year itself now. If probably lectures are scheduled for January. Okay, so if there are no further doubts, I'm just stopping the lecture here for today. I would suggest capital gain is very, very important. Keep revising and keep a lot of focus on capital gain because lot of easy questions are mostly asked from capital gain topic itself. So keep your hold over that. So this is all for today. Thank you so much.